Ever wonder how tiny startups turn into billion-dollar companies? How a group of engineers in a garage suddenly becomes a global tech giant? Behind many of those success stories is a powerful force you rarely see. Welcome to the world of venture capital. Venture capital, or VC, is a type of investment focused on young, fast-growing companies. These are businesses that are often too new, too risky, or too unproven to get traditional bank loans or public stock market funding. Instead, they turn to venture capital firms, groups of investors willing to take big risks in exchange for the chance at even bigger rewards. Think of venture capital like planting seeds in a garden. Most of the seeds won't grow into anything special, but if just one becomes a giant tree, it can make up for all the others. Venture capital firms raise money from large investors like pension funds, university endowments, and wealthy individuals. They then invest that money into startups they believe could become the next big thing. In return, they receive ownership stakes, called equity, in those companies. Unlike banks, venture capitalists don't expect regular interest payments. They make money only if the startup succeeds. If the company grows, goes public, or gets bought by another firm, the VC investors cash out their shares for a profit. But here's the catch. Most startups fail. Some estimates suggest that as many as 70 to 90% of venture-backed startups never become profitable or return meaningful money to investors. So why do venture capitalists keep investing? Because of the power law. In venture capital, a tiny number of investments generate most of the returns. One successful company can return 10, 50, or even 100 times the original investment, more than enough to cover all the failures. That's exactly what happened with early investments in companies like Google, Facebook, and Uber. Early venture investors in these startups made billions of dollars when the companies exploded in value. Major venture capital firms like Sequoia Capital, Andreessen Horowitz, and Kleiner Perkins have built their reputations by backing some of the most successful tech companies in history. But venture capital isn't just about money. VC firms often provide mentorship, industry connections, and strategic advice. They help startups hire executives, raise future funding, and scale their operations. In many cases, venture capitalists even take seats on the company's board of directors, giving them a direct voice in major decisions. Supporters argue that venture capital fuels innovation. It helps new technologies, medicines, and services reach the market faster. Without venture capital, many of today's biggest tech companies might never have existed. But critics say the model also has downsides. Because VCs chase rapid growth, startups can be pushed to expand too quickly, burn through cash, or prioritize scale over sustainability. This pressure can lead to layoffs, failed business models, or companies collapsing after years of hype. So which side is right? The truth is, venture capital is built on risk. It's a high-stakes game where most bets fail, but the winners can reshape entire industries. Today, venture capital firms manage hundreds of billions of dollars and play a major role in shaping the technologies you use every day. From the apps on your phone to the services you rely on, many started as risky ideas funded by venture capital. So the next time you hear about a startup raising millions of dollars, remember, it's not just funding, it's a bet. And in venture capital, the biggest bets can change the world. Like and subscribe for more videos that make money concepts simple.